Welcome back to Author's Note. As you can see, I'm not John Authors. My name's Martin Sandbu. I'm the FT's economics leader writer. I'm standing in for John while he's taking a well-earned break this summer. The markets, however, don't take breaks. With me today to discuss what's happening in the markets now is Lord Skidelsky, economist, historian, and most famously biographer of John Maynard Keynes, who's been back in the news since the crisis. Welcome to Author's Note. Keynes was, of course, not just an economist, but quite a savvy investor. So I thought we could talk a little bit about what his market insights might mean for investors today. And he famously compared markets to a beauty contest. So can we start by you explaining what he meant by that?
Well, yeah, that's a famous metaphor. The idea was that contestants in a beauty contest don't choose the girl who they think is most beautiful, but the girl who they think most people will think are most beautiful. So that, in other words, they don't select on the basis of fundamental values,
right,
but on the basis of crowd values.
So it's the market trying to guess where the market
trying to guess where the market will be or
right,
is,
right,
rather than what the fundamental value of the share is.
Let's take some of the most important market prices in the market today, namely Eurozone bonds. The Eurozone, of course, is where the biggest crisis is still ongoing. These are 10-year government sovereign yields for 4 Eurozone countries: Germany, France, Italy and Spain. And what we see here is that the spreads were almost non-existent before the crisis, very, very tight yield curves. And then they diverged, of course, as the crisis unfolded. So at one point, markets thought they're all the same. Then they thought they're not the same at all. So were they wrong then? Are they wrong now? Or is there some fundamental explanation to this? Or is this just market irrationality?
I think it's a market convention, I would say. The convention before the crisis was that all government debt within the Eurozone carried the same risk. And why that should be the case is very hard in retrospect, right, to understand. Partly it was because I think that they assumed that all governments were running tight fiscal policies, though this wasn't at all clear.
Right, right.
But in a way, it was. The deficits weren't that great. The deficit spreads, right, between the various European countries. So in a way, that did sort of make sense. Then, as soon as the crisis hit, you then got the big, fundamental unsoundness of the private sector financial, right, system being exposed in many countries, with the governments having to bail them out. And then the fiscal problems of a number of states started to look a lot worse.
So that's what broke this market convention.
I think that's what broke it, yes.
Let's move from Europe to the UK, where another Keynesian concept may be at work. These are interest rates in the UK. The green line is the official Bank of England interest rate. The red line is LIBOR, banks' borrowing costs, and the blue one is a mortgage rate faced by consumers, households. And what we see here is that the Bank of England has lowered rates to almost the absolute minimum, but bank borrowing costs have started to creep up, and the mortgage rate has stayed high throughout. Yeah. So is this a liquidity trap? What would Keynes have said?
Well, basically, Keynes would have said that when you've had a very, very big financial collapse, low interest rates on their own are not sufficient to bring about recovery. They can help enormously once a recovery's got going, mm-hmm, and there's a bit of confidence, but they can't actually generate it. And you see the difference in the spreads. It's not only that the official rate has been kept at rock bottom, but the Bank of England have had a big program of quantitative easing, which has been designed to lower this black line, this
right,
tracker rate,
yes,
to nearer where it was there, but it's failed to do so. Why is that? Either because the banks themselves have huge balance sheet problems and have been averse to lending, or I think that is an element, yes, certainly, but I think a much more important element is that there's been a disinclination of businesses to borrow because they don't see the market. And therefore, these sorts of rates, they can't expect to make a profit from the market as it now is. So you have to improve the market.
So we have another set of self-fulfilling expectations coming into play. So clearly, Keynes will be with us for years to come. Lord Skidelsky, thank you very much, and thanks for watching Author's Note.